Today we are going to take a look at Pfizer. Stock ticker symbol PFE. It is headquartered in the USA and service regions all around the world. It has a market cap of $277 billion and is considered a mega cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the healthcare sector and pharmaceuticals industry. Pfizer discovers, develops, manufactures, markets, distributes, and sells biopharmaceutical products worldwide. It offers medicines and vaccines in various therapeutic areas, including cardiovascular, metabolic, and women's health, biologics, small molecules, immunotherapies, and biosimilars under multiple brands, and sterile, injectable, and anti-infective medicines, and oral COVID-19 treatment. In addition, the company is involved in the contract manufacturing business. It serves wholesalers, retailers, hospitals, clinics, government agencies, pharmacies, and individual provider offices, as well as disease control and prevention centers. In short, it is a large international pharmaceuticals company. Its price has been quite stagnant recently. It has a 5-year price return of 86.2% and slightly lags the SPY. The 5-year price chart may help us evaluate how a company performed recently and its ability to weather global events, such as trade war, pandemic, and supply chain issues. It has a 5-year compound annual revenue growth rate of 9%. The revenue growth is unstable and the revenue trend looks ordinary. The revenue trend is important as growing companies often have sales go up first, followed by profit growth. The net income is unstable. The net income trend looks unstable with net income fluctuating wildly. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has been buying back some shares with shares decreasing gradually. It has a nice dividend and has been steadily growing its dividend throughout the years. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of Pfizer is very good and significantly outperforms the historical performance of the SPY. The total return and annual growth rate history of a company can show us what the performance trend was and how it had navigated through difficult times. Most companies tend to perform similarly with a slight decline in growth as time goes by. Pfizer has a 50-year total return of 35.80706% with a 50-year compound annual growth rate of 23%. If you had $1,000 invested 50 years ago, you would have $35,807,061 now. Currently, the price is at around 49 with a 52-week high at 61 and 52-week low at 38. It is near the middle of its 52-week range. It has a P/E ratio of 11 and forward P/E ratio of 7. It has a cash position of $31 billion and long-term liabilities of around $41 billion. The ratio of cash, debt, and market cap may help us evaluate the default or bankruptcy risk and what percent of your share is eroded by debt. Higher debt also has a higher cost in an elevated interest environment. Pfizer is considered a wide moat company according to Morningstar's rating. Currently the margin is 27% and future margin after 5 years is expected to be 37%. The margin is expected to be increasing a lot after 5 years. The company's margin and moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. Now, about the future projection. It has a 5-year forecast revenue compound annual growth rate of -5.4% and 5-year forecast EPS compound annual growth rate of -1.6%. The near-term growth is expected to be bad. It has beaten all of analyst consensus EPS estimates in the last 4 quarters. Looks like it's on the right track to success. The overall analyst recommendation rating is a buy with trend shifting towards buy recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 23 analyst one-year price targets, the range is 49 to 76 with an average price of 60, which is well above the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 3 kinds of discounted free cash flow model results for a more comprehensive review. If we run the DCF perpetuity growth model, the fair price is 81 with an upside of 62%. If we run the DCF terminal EBITDA model, the fair price is 77 with an upside of 56%. If we run the DCF terminal revenue model, the fair price is 76 with an upside of 53%. Now we compare Pfizer with U.S. Treasuries and SPY. It cannot be emphasized more that the U.S. 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 3.1%. The SPY is considered one of the safest and most liquid ETF for investing in the stock market. Big funds and investors directly compare the risk and return of investing in SPY or in individual stocks. The historical return of all stocks follow the earnings trend long term. However, the real return is often reflected by a mix of dividend and buybacks together with revenue or profit growth affecting the valuation. The return yield of SPY is at around 10%. The SPY has an average forward PE around 17.5 now. Pfizer has a dividend plus growth forecast plus shares buyback yield at 0.6% and a forward PE around 7. We have to be cautious that this is just a rough prediction of Pfizer's future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like Pfizer is more expensive than the SPY, and SPY looks like a better buy with a more stable return estimate. We will try to summarize all the information above to give us an overall impression of Pfizer. In summary, Pfizer is a mega cap good company with no growth and wide moat, and probably overvalued now. If you are in your retirement age and want a strong financial fortress that doesn't care about growth, it may still be a good hold long term. Now that's a review for Pfizer stock. Click the subscribe button for more up-to-date stocks review. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time.